Good afternoon. Intelligent people make decisions based on opportunity costs. When it comes to trading the financial markets, what is the opportunity cost that you will be having? If you have two trade setups, let's say you have a trade setup or probability on the euro versus the US dollar, and you have another setup on gold, both of them have the same success probability. Which one will you choose? If time passes by and you find out that both of them were actually profitable, you can still lose by choosing the wrong one of them. You will ask me, what will I lose? I will tell you, you might lose time. Your main task as an analyst or a trader in the financial markets is to make profits. However, the quicker you make profits, the better analyst or trader you are. Because if you're willing to target, let's say 200 pips or 300 pips in a trade, you must do that as quickly and as efficiently as possible to save your time and use your capital again in another trade to make more money. This is how it works. So in trading, when a trader is analyzing and comparing trade setups, opportunity cost is the potential gain the trader gives up by not choosing an investment alternative. So if you have two trades, same success percentage or probability, the faster trade is always the better choice. So today, we were going to talk about the impulsive waves. The impulsive waves, to me, they are the key to generating quick profits. Let's have a look on this chart. This chart is basically for the euro pound. It's on a daily time scale. Right here, we have a perfect short opportunity. I mean, prices have just broken below a recent swing low, so it's a clear downtrend. Prices have started to retrace a little bit and have already broken below the last support. So technically speaking, if you are a trend follower, this is a great opportunity to short. In case you already shorted this or you entered this position, your stop loss technically should be above the last swing high, and your target should be the next support or the following support. You can see that this is a key support level. So this is basically a brilliant short opportunity. This is what happens. This is a stop loss of around 222 pips. The stop loss is just above the recent high, and your target is just the following support. You do have 222 pips for the target and for the stop loss. It provides you with a brilliant one-to-one risk to reward ratio. Let's see how this plays out. As soon as you enter the trade, you can see that prices reversed a lot. We were so close to hitting our stop loss. It was only just a couple of pips difference. However, we didn't get stopped out. Prices started immediately to move in our direction, and by time what happened was we reached our target profit. So you might say that was a brilliant trade. Let me tell you that it wasn't a brilliant trade. Let me tell you why. We entered this trade on Wednesday, the 31st of March, 2021. It took 11 months for this trade to play out on the euro pound on the daily time frame for you to reach the target profit. So why would I spend 11 months in one open position for only 222 pips? It's not worth it. This is another example on the same chart, which is the euro pound on the daily time frame. Another similar opportunity, by the way. Prices has just broken below a swing low, broken below the previous support. Prices are showing momentum to the downside, so let's have another short opportunity here. If I'm going to short this, my stop loss should be above the previous swing high, and my take profit should be the last support or the following support. Let's see how does this play out. This is our short entry. This is our trade setup, stop loss and the take profit. Let's see what happens here. Basically, the target profit was around 300 pips, and the stop loss was 255 pips, more than one-to-one risk ratio, which is better to me. And this trade started on the 14th of October till only the 4th of December. So it was less than 2 months. So the first example, you stayed in the market 11 months for only 200 pips. And in this example, you stayed only 2 months for 300 pips. this, of course, is a better trade. Although both trades are basically a profit, however, the faster one, the better opportunity. In order to try to catch those moves that actually travels fast when prices are traveling quickly to the take profit or the stop loss, you need to understand the price momentum. What is the price momentum? It's basically the velocity of price changes. When markets are calm, prices basically don't travel so much. They tend to be sloppy, and they tend to change and oscillate during or in the same price range. However, when prices are moving fast, you can see that you would be faster to make profits. This is normally what happens in an uptrend, and the opposite happens in a downtrend. Let's see here what the trend starts normally with a weak move. That's often a sideways range, which is called the stagnation phase. Prices then start to have momentum during this acceleration phase. By the end of any trade, buyers start to be weaker. So prices are still traveling to the upside, however, with a weaker momentum. Here you can see the deceleration of the prices, and then another stagnation before the prices reverse. It's somehow like when you drive a car. You can never turn on the car and travel immediately at 200 miles per hour. You must go bit by bit. You gain speed. And just before you reach your destination, you start slowing down the car so you can stop. This is exactly what prices do. In order to be quick in making profits, you need to catch this beginning or this middle phase of the trend when prices are traveling fast, and this is what we call as impulsive waves. Is anyone here an Elliottician? Does anyone here trade using Elliott waves? Only one, two? Okay, three, four. Okay, Elliotticians basically know that the impulsive wave is the fastest wave of all, and this is what we're going to talk about today. This is the Elliott wave principle. Let's quickly have a recap. Basically, it was discovered by someone who's Ralph Nelson Elliott back in the 1930s. He found recurring forms in the patterns by watching the markets day by day by day. He found out that basically prices move in some sort of patterns, and he tried to caricaturize those patterns in names. He gave a name which is the impulsive wave to one form of pattern, and this is what we basically want to focus on. Those are basically part of Elliott wave patterns, not all of them. They are only part of them. And I don't want you to focus on the corrective patterns at all. I just want you to focus on those. The impulsive wave or the impulse wave, and those two, the diagonal waves. Okay, let me tell you that the fastest price move is basically the impulse wave, when prices are traveling really fast in a short period of time. Prices here are going up in this impulse wave. I'm not sure if you can see the laser or not, but this impulse move is basically the fastest one. Prices are traveling to the upside. What happens here? Prices are still going to the upside in the diagonal, however, with lower speed. What happens if we combine both patterns, the impulse wave and the diagonal wave? So prices travel quickly before they start decelerating and reverse the trend. And this is what I want you to focus on. These two patterns, the impulsive wave and the diagonal. The two charts in upward charts are basically in the uptrend, and the exact is in a downtrend. Prices are moving in the impulsive wave and then a diagonal before they reverse. I'll tell you, if you're getting a little bit confused, this will be very clear for you. This is a chart where I have combined both impulsive waves followed by a diagonal wave. So here, prices are traveling to the upside very quickly before they start decelerating in 1, 2, 3, 4, 5, and then they reverse. On the opposite side, in a downtrend, prices are moving quickly in an impulsive wave, 1, 2, 3, 4, and then they start a slower move, 1, 2, 3, 4, 5. If you want to know when prices are traveling quickly and when they are decelerating, I want you to focus on the corrections. What are the corrections? Here, in wave number 1, prices travel to the upside. We all know that prices don't travel in one way. When they go to the upside with a certain amount, they must retrace a little bit. So after wave number 1, prices retraced a little bit for wave number 2. That's a correction. Prices started to move to the upside again to wave number 3 and retraced another part of wave number 4. I want you to focus on the correction phase of wave number 4 and wave number 2, which is highlighted in the rectangles here. If you can see, this price range of the correction didn't overlap with this. This means that prices have momentum to the upside, because when prices make a new high and retrace a little bit, they don't overlap with the previous correction. This is a very strong trend. Let's check what happened after this. Prices moved again in a further impulsive move, retraced a little bit for 2. Did the rectangles overlap here? It didn't. But they are somehow closer to each other. So prices are still strong, however, they are starting to lose momentum a little bit. They started overlapping here. So when prices are doing new highs, however, when retracing, they enter the price range for the previous correction. This is where you know that prices are losing momentum. Prices are about to retrace and reverse to the downside. The other applies basically for the downtrend, which is losing momentum. If you can see, wave number 4 didn't overlap with the correction number 2. This didn't overlap, so the strong trend is to the downside. Here, the waves started to overlap. So this downtrend is starting to lose momentum, which might mean there is a reverse in prices coming. This is normally what happens after this pattern. Prices start strong, they lose momentum, they fall to the downside, and the opposite side, prices start powerful to the downside. They have momentum here, they start losing momentum, and they reverse to the upside. This pattern, which is the impulsive wave, followed by a diagonal wave. Oops, I'm sorry. Sorry, okay. It's fine. This pattern, which is the impulsive wave, followed by the diagonal wave, is what I want you to focus on. I want you to catch this. Wait for a strong trend to take place. Wait for this trend to decelerate and start trading counter trend. Let's have an example here. This is the Bitcoin chart on 2021. Okay. What happened here is that Bitcoin was basically in this stagnation phase. Prices are not moving to the upside. They are still moving sideways here, yeah? They are not going to the upside. Bitcoin started gaining momentum here. It started moving to the upside. Prices are now accelerating to the upside. This is a retracement, another strong move to the upside. What happened here is basically a deceleration in prices. Some classical technical analysts say that this is basically a wedge pattern. I cannot disagree with them. However, I don't agree completely because it's not always a wedge formation. However, this is an ending diagonal, which is coming after a brilliant impulsive wave. What do you expect? After a strong movement to the upside, a deceleration takes place, this happens. A strong and a powerful movement in the opposite direction takes place. This is where I want you to trade. This is where I want you to take a short position, because not only prices will move in your direction, however, it will reach your target faster. Here, basically, you can see that from the 19th of April till the 19th of May, 1 month, 30 days, Bitcoin lost around 41%. If you have shorted this Bitcoin at this time, you have made a lot of profits. This basically is another example to the downside, and this is the coffee chart, coffee prices, okay? What happened here is that prices are moving to the downside, a brilliant impulsive wave, strong and a powerful move. What happens then? Prices start to continue moving to the downside, however, with an acceleration or with a deceleration in move. So a strong movement followed by this diagonal move. What do you expect next is basically a powerful movement in the opposite direction. This is where I want you to be buying coffee. I don't want you to short coffee during this not so powerful movement to the downside. I want you to wait for this downtrend, the weak downtrend to end before buying, because I'm 100% sure that you will get your target quickly. This is how you make and generate quick profits in the markets. As like any other trading pattern, it's not a holy grail. It's not that machine that will make you a lots of money without other indicators. It has some downsides and it has some cons. So how to get better results using this pattern? Maybe you can use RSI. The most common, I believe, indicator in trading the financial markets is the relative strength index, which is the RSI. Almost 95% of the time, when prices are moving in a direction with weak momentum, you will have a negative or a bearish divergence. What is the bearish divergence? Bearish divergence is basically when prices are making new higher highs, but this indicator is making new lower highs. So the behavior of price is no longer with the behavior of the indicator. You know something is wrong. Prices are going to the upside, but the momentum is weak. If this happened, an impulse wave and a diagonal with bearish divergence, you can short this with all of your money. Okay? Or even use support and resistance levels. Because this basically happened, I believe this is the gold chart. It is, yeah. And this is recent. I believe this is August 2022. But this is a small time frame. This is not the daily time frame. What happened here is a strong move to the upside, an impulsive wave, which is a strong one. It's now approaching a resistance level on a daily time frame. So prices started decelerating a little bit. With the bearish divergence, you can short this gold here, and you have reached your target really quickly. Prices have lost around 3.5% in 7 days. Only a week was enough for gold to lose 3.5% because you have combined this pattern all together. The impulse wave followed by the diagonal, if approaching a support or resistance level with the bearish divergence, is a brilliant opportunity. This is the last example. This is a support level. Prices were traveling down quickly before moving kind of sideways. Prices were a little bit decelerating. What happened here? You can see that prices are making lower lows. However, the oscillator or the RSI is moving sideways. This is some sort of a weak divergence. However, it's still a bullish divergence. You touch the support level and you can see what happens on gold. This is not gold, this is oil, crude oil. It starts moving higher and with new, fresh momentum. Thank you so much. Okay. Okay. If you have any questions, please approach me or one of my colleagues at booths number 14 and 17. We will be happy to assist you with that. Thank you so much.